Has this ever happened to you? You place a trade, the market hunts down your stop loss to the exact tick, and then explodes in the direction you wanted it to go. It's insane. That happens because most traders are using things like RSI and MACD. You're looking at the aftermath of a price move, not what actually caused it. Stop using useless indicators that are always one step behind. The richest banks and hedge funds in the world don't use them. So why are you? They make their money using secret price zones, where they hide billions of dollars in orders. In this video, I'm going to show you exactly how to find these zones and plan your trades with crazy accuracy. Before we begin, here's a quick breakdown of the 4 key sections we'll cover in this video. What you'll learn in this video: 1. Understanding supply and demand zones. 2. How to identify and draw zones. 3. How to validate a zone's strength. 4. The execution, entry, stop loss, and take profit. Let's break down the section 1, understanding demand and supply zones. A demand zone typically forms after a sharp upward move, indicating that institutions likely placed large buy orders in that area. It is a price level where buyers are stronger than sellers. When the price returns to this zone, buying pressure often pushes it back up. Supply zone. A supply zone is where sellers are stronger than buyers. It usually forms after a sharp drop, indicating big sell orders from institutions. When the price rises into this zone, selling pressure drives it back down. Here's the secret that makes these so much better than normal support and resistance. Those are just lines. Supply and demand zones are entire areas that represent a crazy imbalance of money. Think about it like this. If a bank wants to buy $1 billion of a stock, they can't just press a giant buy button. That would be insane. The price would skyrocket and they'd get a terrible deal. So instead, they buy slowly and quietly. Every time the price dips into a small range, they place limit buy orders. They do this again and again, but only inside that tight little zone. On the chart, you'll notice price keeps bouncing around in that tight area. This creates a base, a clear sign that someone is buying in bulk, without moving the market too much. That base becomes important. It's not just a random pause. It's a zone where big traders placed many buy orders, but not all of those orders got filled. So when price returns to this area later, those leftover buy orders are still sitting there, ready to push the price back up. Later, if price drops into that zone again, those hidden orders often get triggered and price shoots up with strength. That's what we call a high probability demand zone. On your TradingView chart, look for an area where candles are stacked closely with small wicks and tight consolidation. Then draw a rectangle around that zone from the lowest wick to the highest candle close. That's your demand zone. And it's where big buyers left their footprints. The same thing happens with supply. A bank needs to sell a massive position, so they sell it off in chunks inside a small base before the price completely collapses. Let's say they want to sell at $60. They can't dump it all at once or the price will plummet. So they sell it in pieces between $59.50 and $60.50. That base is now a supply zone, probably filled with their leftover sell orders. Section 2, how to identify and draw zones. Okay, I'm going to show you how to find these zones, and it's so much easier than you think. We're looking for just 4 patterns. That's it. These are giant flashing signs that say, a bank just spent $1 billion here. The best zones are made by a massive explosive move away from a tiny consolidation area, the base. First, here are the 2 patterns that create demand zones where we want to buy. Number 1, drop base rally, DBR. Number 2, rally base rally, RBR. So what's drop base rally, DBR? This is the most powerful reversal pattern. Price is falling, it pauses for a few candles to make a base, and then it literally explodes upward. That tiny base is your demand zone. It shows sellers were in control, then price paused while buyers ate up all the selling, and then the buyers took over with insane force. Number 2, rally base rally, RBR. This is a continuation pattern. Price is already going up, it pauses in a tiny base, and then it launches into another crazy rally. That base is a new demand zone, showing that buyers just took a quick break and then started buying even more. Now here are 2 patterns that form supply zones where we want to sell. Number 1, rally base drop, RBD. This is the classic, most powerful reversal to the downside. You see a huge rally, a tiny base forms, and then a violent drop in price. That base right before the crash is your supply zone. This is where a giant seller stepped in and destroyed the buyers. Number 2, drop base drop, DBD. This is the bearish continuation pattern. The market is already crashing. It pauses to form a tiny base, and then it continues to crash even lower. That base is your new supply zone, showing sellers just took a nap before pushing the market down again. Section 3, how to validate a zone's strength. Always remember that not all zones are good. Some are amazing, A-plus setups, and others are complete trash. I'm going to show you how to tell the difference. Every zone has to pass these 3 tests. Test 1, how fast did the price leave? How price leaves the base is the biggest clue you have. If a bank just dropped $1 billion, the price should launch away from the zone like a rocket. We want to see huge explosive candles with tiny wicks. This shows a powerful, crazy imbalance. If the price just slowly drifts away, it's a weak zone. The bigger the explosion, the stronger the zone. Test 2. Has the price been here before? This is so simple, but it is everything. A zone is fresh if price has not returned to it since it was created. Fresh zones are the best of the best. Why? Because every time price comes back to a zone, it uses up some of the orders waiting there. The very first time it comes back has the most power. A zone that's been hit over and over is useless and weak. Always trade the first test of a fresh zone. Test 3. Is anything else happening here? Confluence is when you have a bunch of reasons to take a trade all lining up in the same spot. A zone with confluence is an A++ setup. I look for 3 main types. Number 1, confluence with market structure. When your supply zone is sitting at the exact price level of a previous major high, you're not just looking at a random resistance. You're staring at a level where the market already reversed once with power, or let's say your demand zone lines up with a strong upward trend line that's already been respected multiple times. Now you've got 2 solid reasons for buyers to step in again at that price. This kind of alignment adds serious weight to your setup, and when big institutions see that same structure, that's when price reacts with force. 2. Confluence with psychological levels. The market cares about big round numbers. Prices like 1.20 on the euro or $200 on a stock are like psychological magnets. When a fresh zone forms on one of these numbers, it becomes a superpowered wall. 3. Confluence with higher time frames. This might be the most important one. A 1-hour zone that's inside a giant daily zone, that is a god-tier setup. It's the best of the best. You can find a massive daily demand zone, then zoom into a smaller time frame to find the perfect sniper entry inside of it. If you check every single zone with this 3-point test, strength, freshness, and confluence, you will find insane trades. If your mind is blown right now, and this is finally making sense, do me a favor and smash that like button. It tells YouTube we're giving you insane value. And if you don't subscribe right now, you'll miss the next video where we do something even crazier. All right, let's continue this video. Section 4, the execution, entry, stop loss, and take profit. Okay, you found an insane zone. That's only half the battle. If you mess up this next part, you lose. I'm going to show you how to execute the trade perfectly. This means knowing exactly where you get in, where you get out if you're wrong, and where you take your profit. Entry strategies. There are 2 main ways to get into a trade. Number 1, the risky entry, limit order. This is where you set a limit order right at the edge of the zone and just wait. For a demand zone, a buy limit. For supply, a sell limit. The good part is you're guaranteed to get in the trade because these reversals can be so fast you'll blink and miss them. The bad part is you're jumping in before you know for sure the zone will work. Number 2, the smart entry, the pro's choice. This is the method I recommend. You wait for price to come into your zone, and then you look for a giant sign of rejection before you enter. And one more important thing. Your stop loss is everything. You have to use one. No excuses. It's your safety net. The rule is simple. Your stop loss goes just on the other side of your zone. For a buy trade from a demand zone, your stop loss goes a few pips below the low of the zone. For a sell trade from a supply zone, your stop loss goes a few pips above the high of the zone. Give it a little bit of space. Don't put it right on the line. The most logical place to take profits is at the next opposing zone. If you buy from a demand zone, Your target is the first fresh supply zone you can find above you. If you sell from a supply zone, your target is the first fresh demand zone you can find below you. This makes sure you're trading from one pile of money to the next. Before you even think about entering, you have to know your entry, stop loss, and target. This lets you see your risk to reward ratio. You should only take trades where you can make at least twice what you're risking. If you can't, don't take the trade. It's that simple. Conclusion. And there you have it. A complete step-by-step framework for understanding and trading with supply and demand logic. We covered the 4 powerful price patterns that often show up after institutional activity, how to rate zones for higher quality setups, and how to execute your plan with confidence from entry to stop loss to take profit. What makes this strategy so effective is its structured and rule-based approach. You're not guessing, you're analyzing how price behaves around key levels and learning to respond with patience and precision. Now here's your challenge. Open up a chart, scroll back in time, and mark out 10 potential supply or demand zones using everything you've just learned. Don't place trades, just spot them. Get comfortable recognizing these zones until you can do it in your sleep. Because this style of trading doesn't reward impulse, it rewards discipline, repetition, and focused practice. And if you master this one skill, it could completely shift how you see the markets forever.